Okay, so 100 investing methods. That's a lot to wrap your head around, right?
Can be, yeah.
But for this deep dive, think of us as like your cheat sheet to navigate through all of that. We're breaking it all down into something a little bit more digestible.
Definitely.
So by the end of this, you'll not only know, the difference between a bull and a bear market, you'll understand, how all these different approaches connect.
Exactly. I mean, with so many options, it's definitely easy to get overwhelmed, but having a framework to approach the investment landscape can make it much less intimidating.
Right. It's like having a roadmap, right? You don't have to visit every single destination.
Right.
But at least you have a general idea of how to navigate.
For sure.
So let's talk about, some of those key categories that we're seeing in this list. You've got your classic buy and hold approach, which is, kind of self-explanatory.
Yeah, it's a long-term strategy. You purchase assets, stocks or bonds, and you hold on to them for an extended period, often years or even, decades.
Right.
And, you're weathering those market fluctuations.
Riding the wave.
With the expectation that, their value will appreciate over time.
Right, exactly. And then you've got your more active strategies like day trading, which sounds a bit more like a full-time job almost.
It definitely can be. Day trading is all about buying and selling assets within a single trading day, trying to capitalize on those short-term price movements. And that requires, constantly monitoring the markets and having, a high-risk tolerance.
Yeah, for sure.
It's definitely not for the passive investor.
Definitely not for the faint of heart.
Yeah.
So we're already starting to see this kind of spectrum of involvement here,
Yeah.
from set it and forget it to like always on alert.
Yeah, exactly.
But I mean, wouldn't the best approach really just depend on the individual investor, their goals, and how much risk they're comfortable with?
Absolutely. There's no one-size-fits-all answer when it comes to investing. It's all about tailoring the approach to your individual circumstances. It's kind of like if you think about a marathon runner training differently than a sprinter, right?
Right.
They're both athletes, but different approaches.
Okay, I love that analogy. It makes total sense. So now let's zoom in on a few of these methods that really stood out to us in this list. Like dogs of the Dow strategy. This one sounds really interesting.
It's a strategy focused on investing in the 10 Dow Jones Industrial Average stocks that have the highest dividend yield.
Okay.
So the theory is that these stocks, these dogs, often undervalued by the market, will likely outperform in the long run.
Right.
They've got potential.
So it's like betting on the underdog.
Right.
The ones that might just surprise everyone. I'm already starting to see how this list can help you kind of think differently about investing.
Yeah, for sure. And if you think about it in the context of, the tech bubble of the late 90s, dogs of the Dow might have actually helped some investors, avoid some of the pitfalls of chasing those, high growth, high risk tech stocks at the time.
Yeah. That's a great point. It highlights how those different strategies perform differently given the different market conditions.
Exactly.
So another one that caught our eye was socially responsible investing, or SRI. This seems to be getting a lot of traction lately, especially with investors who want their money to align with their values.
Exactly. SRI is where investors prioritize companies that meet certain, ethical, social, or environmental criteria. It's about generating financial returns while also, contributing to a positive impact on the world.
So doing well by doing good. But I mean, even with these strategies like dogs of the Dow or SRI, wouldn't you still have to do a ton of research before, jumping into any of them?
Absolutely. No matter how tempting a strategy might sound, research and due diligence are really crucial. You need to understand the underlying assets, the potential risks and rewards, and how they align with your overall, investment goals.
Right. It's not just about picking a catchy name from a list.
Exactly.
You really have to understand the why behind it.
Right.
I'm guessing risk assessment plays a big part in that too, right? Because some of these strategies are inherently riskier than others.
For sure. Every investment carries some level of risk, and it's important to align that risk with your, personal tolerance. For example, day trading, which we discussed earlier, carries much higher risks compared to a long-term, buy and hold approach.
Right.
big difference.
And that risk tolerance is probably different for everyone.
Right.
Someone nearing retirement probably, isn't comfortable with the same level of risk as someone in their, 20s.
Exactly. Your risk tolerance is influenced by your age, your financial goals, and even your personality. It's a really, really important factor to consider when you're choosing any, investment strategy.
Yeah. So, I mean, this list is a great starting point. It gives us a sense of the, different approaches out there. But even with 100 methods, I'm sensing that we're just, scratching the surface here.
Oh, absolutely.
Right. Like there's a whole universe of knowledge beyond this list.
Definitely. While the list is helpful, as a guide, it definitely doesn't cover everything. There are many factors that can, influence your investment decisions.
For example, I bet this list doesn't tell us much about, market cycles, does it?
Right.
Understanding those ups and downs seems pretty critical.
Yeah, market cycles are, they refer to that, cyclical nature of the stock market, those periods of expansion and contraction.
Yeah.
And being aware of these cycles, helps you make more informed decisions.
Gotcha. So understanding market cycles, check. And I'm guessing this list also doesn't cover things like inflation or interest rates. Like how do those fit into, the equation?
Yeah, economic factors like inflation and interest rates can have a huge impact on your investments.
Right.
Inflation erodes your purchasing power. Interest rate changes can influence, your borrowing costs.
Right.
And even the overall market environment. So understanding those broader, economic forces is crucial for making those investment decisions.
So it's not just about picking a strategy from a list.
Right.
It's about understanding the bigger picture.
Absolutely.
And I have a sneaking suspicion this list doesn't touch on the emotional side of investing either.
Yeah.
Like, let's be real, fear and greed can really mess with our, decision making.
Oh, absolutely. Emotions play a huge role in investing, yeah?
Right.
Fear can lead to selling at the wrong time. Greed can drive us to chase, those risky investments. So learning to manage those emotions and sticking to a well-defined plan is really crucial for long-term success.
So it's not just about the numbers and the strategies.
Yeah.
It's also about mastering our own psychology.
It's a mental game for sure.
Wow, this is fascinating. So we've gone from this seemingly overwhelming list of 100 methods to realizing like there's this whole universe of knowledge that's just as important.
Yeah, it can be a lot to process.
So what does all this mean for our listener who is just starting out?
Well, it's about recognizing that this is a journey.
Right.
It's not a race. The key is to start with a solid foundation of knowledge and then, build upon it over time. The good news is there are tons of resources available to help you, learn and grow as an investor.
Right. It's like building a house. You got to start with a strong foundation.
Exactly. And as you learn and gain experience, you can refine your investing style, tailor your approach to meet your specific needs.
Okay. So we've covered a lot of ground here in this first part of our deep dive. We started with a list of 100 investing methods, explored some of those key categories, and even touched on some crucial concepts that go beyond that list itself.
We definitely laid a solid foundation. Now, in the next part of our, deep dive, we're going to actually delve into some specific investing methods in a lot more detail, unpacking their nuances and highlighting those potential pros and cons.
Sounds good. Yeah, I'm ready to dive deeper. Okay, so we're back for part 2 of our investing deep dive.
Mm-hmm.
In the first part, we talked about how important it is to have a framework, for understanding those 100 investing methods. Now, I'm kind of curious to actually explore some specific approaches.
Yeah.
Yeah, in a little bit more detail.
Yeah, definitely. Let's start with one that's often considered a cornerstone of building a portfolio: index investing.
Okay, index investing. Now, I'll admit, when I first heard about this, I thought it sounded a bit, kind of boring.
Yeah.
Like, isn't the whole point of investing to try to beat the market?
It might seem a little counterintuitive,
Right.
but sometimes, boring can be quite effective in investing.
Yeah, okay.
So with index investing, instead of trying to pick individual stocks, you know what you do? You invest in a fund that tracks a specific market index, like the S&P 500, which is, a collection of 500 large U.S. companies.
Gotcha. So you're basically putting your money on the overall performance of the market. rather than trying to outsmart everyone else by picking individual winners.
Exactly. And this strategy has a couple of key advantages. First, it's typically low cost because you're not paying someone to actively manage those investments.
Right.
Second, it provides instant diversification, because you're spreading your risk across a wide range of companies.
Less risk, less hassle, lower fees.
Exactly.
I can see the appeal,
Yeah.
especially for someone who's just starting out.
Yeah.
But what about those of us who maybe want to be a bit more active with their investments? What kind of strategies might fit that bill?
Sure. Let's shift gears then and talk about quantitative investing.
Okay.
Or quant for short. This approach relies on data and algorithms to make those investment decisions, often involving, complex mathematical models to analyze market trends and identify, potential opportunities.
Whoa, that sounds pretty intense.
Yeah.
It's like the intersection of finance and computer science.
Mhm.
Are we talking about robots taking over Wall Street?
Not quite robots, but definitely a data-driven approach, yeah.
Okay.
Think of it this way. If you were trying to predict which baseball team will win a game, you might look at their past performance, player stats, and even things like, weather conditions.
Yeah.
A quant investor would do something very similar, but with massive amounts of data and sophisticated algorithms,
Right.
looking for patterns that, that can give them an edge.
So it's about finding those hidden signals that the average investor might miss.
Exactly.
But wouldn't you need a pretty strong math background to even attempt this?
While quant strategies can get very complex, the core idea is accessible to anyone. It's about using data to inform your decisions,
Right.
which is something we all do in different aspects of our lives. Like when you're choosing a route for your commute, you might use a navigation app that analyzes traffic patterns to find the fastest way.
Right.
Quant investing applies that similar data-driven approach to the financial markets.
Okay. So I see how the principles can be applied even outside of, Wall Street.
Absolutely.
That's a good way to break it down. And let's talk about something that feels a little more tangible. Real estate.
Mm.
I see real estate investment trusts or REITs on this list.
Yeah.
I heard about those, but I'm not entirely sure how they work.
Sure. So REITs are, they provide a way to invest in real estate without having to buy and manage properties yourself. They're companies that own and operate, income-producing real estate, like shopping malls, office buildings, or, apartments.
So instead of being a landlord, you're essentially becoming like a part owner of a company that owns a bunch of properties.
Exactly. And one of the appealing aspects of REITs is that they are required to distribute a significant portion of their profits to shareholders as dividends.
Ah.
So this can provide a consistent stream of income for investors.
Okay. So you get potential appreciation in the value of the underlying real estate, plus you get regular income from those dividends.
Mm-hmm.
That sounds like a pretty sweet deal. But I imagine there are some downsides too, right?
Of course, like any investment, REITs carry risks. The value of real estate can fluctuate, just like stocks or bonds, and economic factors like interest rate changes or a downturn in the real estate market can impact their performance.
So diversification is key, even within a specific asset class like real estate.
That's a crucial point.
Okay, makes sense. Now this next one really caught my my attention: peer-to-peer lending, or P2P. It sounds like something that wouldn't have even existed a few years ago.
Right.
Can you explain what that's all about?
Yeah. Peer-to-peer lending has emerged with the rise of, these online platforms that connect borrowers directly with lenders,
Okay.
cutting out traditional financial institutions like banks.
It was like being the bank yourself, right?
Yeah, exactly.
You lend money to individuals or businesses, and they pay you back with interest.
Yeah, that's the general idea.
Yeah.
P2P lending can potentially offer, higher returns than traditional savings accounts or bonds, but it also, comes with higher risk.
Right.
You're relying on the borrower's ability to, repay their loans, and there's always that possibility of default.
Yeah. It's a reminder that risk and reward often go hand in hand.
Absolutely. And that brings us to a concept that kind of, weaves its way through all of these investing methods Diversification.
Right.
We touched on it briefly with index funds, but it's a fundamental principle for any investor, regardless of their chosen strategies.
So diversification, spreading your investments across different asset classes, industries, and even strategies, right?
Precisely. It's like the old adage about not putting all your eggs in one basket.
Oh.
By diversifying, you reduce the impact of any single investment performing poorly.
Okay. So diversification is like the safety net of investing.
Yeah.
And it's not just about what you invest in, but also when you invest, right? That's where, understanding market cycles comes in.
You're exactly right. Remember we talked about those market cycles earlier.
Right.
Well, one way to take advantage of those cycles is through a strategy called dollar cost averaging.
Dollar cost averaging.
Yeah.
It sounds like something you'd learn in an economics class.
It's actually a pretty simple concept.
Yeah.
Instead of trying to, time the market perfectly, you invest a fixed amount of money at regular intervals, regardless of market conditions.
So whether the market is up or down, you just keep investing consistently.
Exactly. This way, you buy more shares when prices are low and fewer shares when prices are high, potentially lowering your average cost per share over time.
Okay, that makes sense. It's like a built-in mechanism for navigating those market ups and downs.
Yeah.
So we've talked about index funds, quant investing, REITs, peer-to-peer lending, diversification, and dollar cost averaging. We're starting to see how all these pieces fit together, right?
So you're catching on. And remember, this is just a sampling of the approaches that are out there.
Right.
The key is to find what resonates with you, your goals, your risk tolerance, and your overall investing philosophy.
And speaking of investing philosophy, it seems like this goes beyond just picking methods from a list. It's about developing a personal approach, a way of thinking about investing that kind of guides your decisions, right?
You've hit the nail on the head. That's what we'll dive into next.
Okay.
We'll talk about how to develop your own investing strategy, one that's tailored to your unique circumstances and helps you navigate the financial markets with confidence.
Okay. I'm ready for that. Let's move on to the final part of our deep dive and talk strategy. Okay, we're back for the final part of our investing deep dive. We've explored a ton of different methods and strategies, but now I'm kind of curious, how do we actually put all these pieces together?
Yeah, how do we create a personalized approach?
Right, exactly. It's like having all the ingredients for a delicious meal, but we need to figure out the recipe. So what are the key elements? Where do we even begin?
Well, it all starts with defining your financial goals, right? Where do you want to go with your investments? Are you saving for, a dream home, early retirement, maybe starting your own business?
Okay, so it's not just about making money. It's about having a clear picture of what you want that money to do for you.
Exactly. Having well-defined goals will shape, all your investment decisions every step of the way. It's like, setting your destination on a map, right? Once you know where you want to go, you can figure out the best route to get there.
Right, gives you direction. So once you have those goals in mind, what's next?
Then you need to consider your time horizon. How long do you have to reach those goals?
Right.
Are you investing for the next 5 years, 10 years, or even longer?
Yeah, I'm guessing that time horizon probably influences how much risk you're willing to take on.
Absolutely. If you have a longer time horizon, you can generally tolerate more more risk. You have more time to recover from any market downturns. But if you need the money sooner, you might want to be a little more conservative. Think of it this way. If you're planning a long road trip, you might be willing to take a few detours, explore some back roads.
Yeah.
But if you're just trying to get across town for a meeting, you'll probably stick to the main highway.
Okay, I like that analogy.
Yeah.
Helps to visualize it. So we've got our goal and our time horizon, sorted out. What's the next piece of the puzzle?
Now comes the fun part. Assessing your risk tolerance. How much volatility are you comfortable with? Can you stomach those ups and downs, or do you prefer a smoother ride?
Right. Not everyone is comfortable with a roller coaster, even if the potential payoff is higher.
Exactly. There's no right or wrong answer when it comes to risk tolerance. It's about understanding your own comfort level.
Right.
And choosing investments that that align with that. So it's kind of like choosing a spice level for your food, you know?
Right.
Some people love the heat, while others prefer a milder flavor.
So we've got our goals, our time horizon, and our uh, risk tolerance mapped out. What's the next step in building our investment strategy?
It's time to talk about asset allocation. This is where you decide how to divide your investments among different asset classes like stocks, bonds, and real estate.
So it's about building a diversified portfolio, making sure we're not putting all our eggs in one basket.
Exactly. And the right mix will depend on your goals, your time horizon, and your risk tolerance. For example, stocks generally offer higher potential returns, but also come with higher, volatility. Bonds tend to be more stable, but may not grow as quickly.
So it's about finding the right balance, that sweet spot between risk and reward.
Exactly. It's like creating a well-balanced meal with different, food groups to make sure you're getting all the nutrients you need.
So I'm realizing now that building an investment strategy is a pretty involved process.
Yeah.
It's not just about picking a few stocks and hoping for the best. It's about understanding yourself as an investor,
Mhm.
your goals, your comfort level with risk, and how all these pieces kind of fit together.
You got it. And the best part is, as you learn and gain experience, you can adjust your strategy along the way. It's not a set it and forget it kind of thing. It's a dynamic process that evolves as you do.
So this deep dive has been about more than just exploring a list of investing methods. It's been about empowering ourselves to take control of our financial futures, become informed decision makers.
Exactly. It's about shifting from feeling overwhelmed by all this complexity to a sense of, confidence and clarity.
I definitely feel a lot more confident now than I did before we started this deep dive. We went from a list of 100 methods to a framework for understanding those methods, and now we even have the tools to build our own personalized investment strategies.
And remember, this is just the beginning of your journey. The world of investing is constantly evolving. So continuous learning is key. Stay curious, explore, and most importantly, take action.
Yes, knowledge without action is like a car without an engine. It won't get you anywhere. So to all our listeners out there, I encourage you to take what you've learned from this deep dive and start building your own path to financial success.
Happy investing.